this video we're going to continue our discussion about cost volume profit analysis, and we're going to focus it more on what we call it graphic approach to cost profit volume analysis. So the cost volume profit chart, sometimes we refer to it as the break-even chart. It's a graphical presentation that shows sales, cost, and the related profit or loss for various levels of units sold. So to understand that, let's try to see an example. Assume we have a company called Munoz Company, and we have a total fixed cost of 100,000. Their unit selling price is 50, their variable cost is 30, so their unit contribution margin is 20. There are a few steps that we have to follow in order to be able to construct a cost profit volume chart. I'm not going to read these steps, I'll try to apply it later on. So we'll see the graph and see how we can apply it. So in the first step, we have the horizontal axis and the vertical axis. In the horizontal axis we present the units of sales, and in the vertical axis we'll have the dollar value sales and costs. In the second step we want to calculate the total sales. So we start with the point 0, and we always assume at 0 unit of sales the sales dollar value would be $0. And then we calculate another point, let's say at the maximum point, like at 10,000 units of sales, that would generate 500,000 in revenue. And then we connect these two lines, and that would be our total sales line. And then the next line would be the total cost. And then the total cost will have to start from the fixed cost point. And then we calculate the cost at $10,000, and let's assume here it's about 400,000. So we connect the line here, and that would be this third step. In fourth step, we try to find the intersecting point of the total sales and the total cost lines. And that would be the point of break even. So at 5,000 units, we're going to make sales of $250,000, but our cost would be also $250,000, which would lead to zero profit. In other words, we are going to be breaking even. So changes in the unit selling price, total fixed cost, and unit variable cost can be analyzed by using a cost volume profit chart. And that's why many managers, they like to visually see this kind of cost volume profit analysis, because without it sometimes it's hard to understand what's going on. But this is a very good presentation to visualize how much we can make, or based on an increase in sales and so on and so forth. So using the data in Exhibit 14, assume that Munoz is evaluating a proposal to reduce fixed cost by $20,000. The total fixed cost would be $80,000 instead of $100,000. So in the next exhibit, which is another chart, the total cost line would be redrawn, starting at 80,000 instead of 100,000 on the vertical axis. So here, this starting point here, instead of being at the 100,000, we're taking it slightly down at 80,000. So that would change the line, or at least the starting point of the line. So since the starting point of the total cost line is going to change, the point of break even, or the break even point, would be at a lower value. The second point is determined by multiplying the maximum number of units in the relevant range, which is found on the far right of the horizontal axis, by the unit variable cost and adding the fixed cost, the same way we've done it in the previous chart. The revised cost volume profit chart in this exhibit indicates that the break-even point for the company decreases to 200,000 and 4,000 units of sales. So if you look here, we notice that it went down from 5,000 to 4,000, and the break-even point went down from 250,000 to 200,000. Again, that's another good visualization to or for them, any kind of changes in the fixed cost, how things would be impacted when we change one of our important variables. So the profit volume chart, that's another chart that we're going to see, but it only focuses on profit. Okay, so it's not like the previous one where we have the sales and the cost. Now we're only focusing on profit. It plots only the difference between total sales and the total cost, or in other words, the profit. The profit volume chart allows manager to determine the operating profit or loss for various level of units sold. So given the same information that we had for Munoz company, we are going to calculate the maximum operating profit, which is 100,000. So the sales is 500,000, the variable cost is 300,000, contribution margin would be 200,000, the fixed cost, which is our starting point, is 100,000, and the operating profit would be, that's the maximum point, $100,000. That's at a sales of 10,000 units. Again, there are a few steps that we have to follow. I'll just apply it like directly on the chart. So step number one, we're going to have the x-axis or the horizontal axis where we have the units of sales, and the y-axis, or what we call it the vertical axis, this is where we have the operating profit or loss. And notice we have positive numbers and negative numbers, and the negative numbers would be between parentheses, and this would be the red zone. And then we start with our fixed cost, and that would be at units of sales of 0. It would be a negative $100,000. That's our fixed cost. So it would make our operating profit minus $100,000 if we make 0 sales. And then in step 3, we calculate at 10,000 units of sales, and we already found that the operating profit would be 100,000. So that would be the second point. So step 4, we're going to connect this line. So between the 0, or I mean the 0 point of units of sales, and the unit of 100,000, which is at $100,000, the 10,000 units of sales. The break-even point would be this point here where the line, the profit line, intersects with the 0 line. I call that the 0 line, which is a horizontal line parallel to the line where we have the units of sales. But notice here it's a 0. So at this point, that's the break-even point. And anything on the right would be an operating profit. Anything on the left would be an operating loss. So if we make any sales on top of the 5,000, that would be the operating profit area. Anything below 5,000 would be the operating loss area. So for example, if we say that we want to make 8,000 units of sales, then that would lead to $60,000 of profit. Changes in the unit selling price, total fixed cost, and the unit variable cost on profit can be analyzed using a profit volume chart. So using the data in the exhibit 16, which we've just covered, consider the effect that a $20,000 increase in fixed cost will have on profit. Of course, when we increase the cost, our profit will go down, especially when we increase the fixed cost. So since we increase it by 20,000, we expect that our maximum operating profit will go down to 80. So we did the calculation here. The sales is 500,000, the variable cost 300, contribution margin 200,000. We increased the fixed cost from 100 to 120, so that made the operating profit 80,000. That's the revised maximum profit. So a revised profit volume chart is constructed by plotting the maximum operating loss and the maximum operating profit points and drawing the revised profit line. And here we can see that the revised profit line has moved or shifted to the right. So our break-even point now is at 6,000 units. In order to break even, or in other words, to have a 0 profit, we have to produce more or sell more. And here we have the 6,000 units, and compared to 5,000 units, which was when we had the fixed cost of $100,000. So again, you can see that this kind of graphs will give us a better visualization for the impact of any changes in the variables that we are dealing with. The same way dealing with graphs, we can also use spreadsheets. And I think spreadsheets nowadays for any decision maker is an important tool. And I encourage all of you to be very comfortable and train yourself to deal with spreadsheets. I think it's a very useful tool in accounting and in business in general. So the use of spreadsheets and assumptions in cost volume profit analysis. With spreadsheets and graphs, managers can vary assumptions regarding selling prices, cost, and volume, and can observe the effect of each change on the break-even point and profit. This analysis, sometimes we refer to it as what-if analysis, or it's good to known as, or good to be known as, or well known as sensitive analysis. So cost volume profit analysis depend primarily on several assumptions. Things like total sales and total cost can be represented by a straight line. Within the relevant range of operating activity, the efficiency of operations does not change. Cost can be divided into fixed and variable components. The sales mix is constant, and there's no change in the inventory quantities during the period. So these are the assumptions that we always have to keep in mind in order to be able to apply this kind of cost volume profit analysis. Now let's talk about the special cost volume profit relationship. Many companies sell more than one product at different selling prices, and this is what we call it a sales mix. So I think we've been using only examples for one product, but in real life there are usually more than one product. Of course, there are several products of sales. But again, for simplicity, let's assume that we're having only two products as a sales mix. So the break-even analysis can still be performed by considering the sales mix. The sales mix is the relative distribution of sales among the products sold by a company. So let's see an example. Assume we have a company called Cascade. They sell product A and B during any period, and during the past year they made these kind of sales. Their total fixed cost is $200,000. Their selling price for product A is $90 and for product B is $140. For their variable cost it's $70 and $95, and their contribution margin is the difference here. You can see that for product A is $20 and for product B is $45. The number of units sold of A in the past year were 8,000 units, but for product B it's 2,000 units. So the sales mix here, you can see if we add them up, it's 10,000 units. That represents 80%, and product B represents 20%. So the sales mix for products A and B is expressed as a percentage of the total units sold. For Cascade, a total of 10,000 units were sold during the year. Therefore, the sales mix is 80% for product A and 20% for product B. So you can see here in this kind of pie, 20% is product B and the majority is product A, which is 80%. We like to call that the sales mix. Keep in mind, we're only looking at number of units. We do not include the dollar value. So for Cascade Company, this mix of company products is labeled M. So let's assume the 80-20% mix, we call it M mix, okay, or product M, which is like we try to combine it together in a name of a new product, and that's called the product M. The unit selling price of M equals the sum of the unit selling price of each product multiplied by its sales mix percentage. The unit variable cost and unit contribution margin of M equal the sum of the unit variable cost and unit contribution margins of each product multiplied by its sales mix percentage. So let's try to see how that works. So the selling price of the mix M, for product A, it's $90 multiplied by 80%, and for product B is $140 multiplied by 20%. We do the math, and then the selling price for the mix is $100. If we look at the variable cost, it's $70 at 80% and $95 at 20%. So the 0.2 is 20%, 0.8 is 80%. We do the math, make sure that you do these separately, and add them together, then that's $75. So that would lead to a contribution margin for the product mix of $25. If we want to do the contribution margin separately, then it's 20 multiplied 80% and 45 multiplied by 20%. Again, we do the math, it has to be $25. Remember, the fixed cost for the company was $200,000. So the break-even point of the 8,000 units of the M mix can be determined using the unit selling price, the unit variable cost, and the contribution margin of M. So we have here the $200,000 fixed cost and the unit contribution margin $25 that we just calculated here, and that would give us 8,000 units. So 8,000 units need to be sold in total for the mix to be able to break even. Because the sales mix for products A and B is 80% and 20%, then we take the 8,000 multiplied by 80%, and these would be the number of units for product A, which is 6,400. And we do the same thing, 20% multiplied by 8,000 units, and that would be 1,600. That's the number of units for product B. The effects of changes in the sales mix on the break-even point can be determined by assuming a different sales mix, and the break-even point of M can then be recomputed. So here we have product A and product B. We have the 6,400, the 1,600 multiplied by 90 and 140, and these were our total sales, $800,000. The variable cost, we've done the same calculations, and we got 600,000. The contribution margin was 200,000. The fixed cost, we know it's 200,000. If we subtracted, the operating income would be 0, which is the break-even point. Remember, break-even point is when our revenue match our cost, and that would be our operating income equals 0. Now let's talk about something called operating leverage. And this is just some kind of ratio that we have to understand how it's calculated. Very simple. As long as we know the terminologies, now everything would be easy. The relationship between a company's contribution margin and operating income is measured by what we refer to as operating leverage. How we calculate it? It's contribution margin divided by operating income. So the difference between the contribution margin and operating income is fixed cost. Therefore, companies with high fixed cost would normally have high operating leverage. So assume this information for two companies. One is Jones Incorporated and the other is Wilson Incorporated. Their sales are the same, their variable costs are the same, their contribution margin has to be the same, but the fixed cost for Jones Incorporated, which is 80,000, is higher than Wilson Incorporated, which is 50,000. That leads Wilson Incorporated to have a higher operating income compared to Jones Incorporated. So Wilson would have $50,000 in operating income versus Jones of only $20,000 operating income. So now let's see the operating leverage for each one of these companies. So for Jones, it's the contribution margin, which is 100,000, divided by the operating income of 20,000. So the operating leverage is 5. For Wilson, the operating leverage is 100,000, which is the same contribution margin for the other company, but since the operating income here was higher, we take 100,000 divided by 50, and the operating leverage is 2. Operating leverage can be used to measure the impact of changes in sales on operating income. So percentage changes in operating income is equal to the percentage change in sales multiplied by the operating leverage. Of course, the higher the operating leverage, the bigger the impact of percentage change in sales on the percentage change in operating income. So for Jones Incorporated, when they make more sales, since their operating leverage is higher, this would show a bigger percentage change in their operating income versus Wilson. So assume that sales increased by 10% or $40,000 for Jones and Wilson. Let's see how that would impact the companies. Keep in mind, we had 20 versus 50. So we do the same calculations. The sales now is 440. The variable cost is 330. The contribution margin is 110 for each one of the companies. The fixed cost is 80 and 50. So the operating income went up from 20 to 30,000, which is 50% more. But for Wilson, it went up from 50,000 to 60,000. That's only 20% increase. So that shows you that because the operating leverage here is higher for Jones Incorporated, the $10,000 increase made a big percentage change for Jones. Somebody would think, oh, but at the very end of the day, both of them only increased by 10,000. That's true, but relatively speaking, compared to their previous operating income, for Jones, it has a bigger or much bigger increase compared to the percentage increase for Wilson. So the effect of operating leverage on operating income. Because even a small increase in sales will generate a large percentage increase in operating income, Jones might consider ways to increase sales, such as special advertising or sales promotions. On the other side, Wilson might consider ways to increase operating leverage by reducing their variable cost. So, operating leverage, when it's high, the percentage impact on operating income from a change in sales would be larger than if the operating leverage is low. Another thing that we're going to learn briefly is something called the margin of safety. The margin of safety indicates the possible decrease in sales that may occur before an operating loss results and may be expressed in dollars of sales. So units of sales and the percentage of current sales. You can think of it as the safety margin. So margin of safety or safety margin. How much I can still not make in sales and I'm still okay. So assume the following data. We have a company that makes sales of 250. Their sales at the break-even point is 200,000. The unit selling price is $25. So the margin of safety in dollars of sales would be calculated as follows. We have the sales minus the sales at break-even point divided by their sales. So 250,000 minus $200,000 divided by 250, that would give us 50 over 250, which is 20%. So the company can still lose up to 20% of their sales, and they can still break even. Anything more than 20% of their sales, then this would be dangerous. That would take them into the red zone where they would have losses. So let's see an example that we can, or test our knowledge using this example. So Whitman Industries had sales of 800,000 at the end of the year. Its break-even point for sales was 680. What is the margin of safety expressed as a percentage of sales? So basically we get 800 minus 680, and that would be 120,000, divided by the sales, which is 800, and that would give us our safety margin, or the margin of safety. So in this case, 800 minus 680 divided by 800, that's 15%. So the right answer is D. The very last part of this chapter is just an analysis for decision making. And here we're going to see the cost volume profit analysis for service companies. Everything we've been talking about so far has been based on sales. But how about service companies? Companies that provide services like universities, hospitals, and things like that. So the break-even point is as relevant in a service company as it is in a manufacturing company. The cost volume profits relationships in a service company are measured with respect to customers and activities rather than units of product. So for education, we have the break-even here would be students per course. For air transportation, it could be passengers per flight. Healthcare or hospitals, it could be patients per outpatient facility. Hotel is number of guests per time period, like a day or month, and so on. And so on. There are so many other examples here you can consider as a way of trying to see how the service companies can also rely on cost volume profit analysis. So let's see this example, and it relates to universities and or colleges, and let's see how this works. Consider the break-even number of students for a non-credit course in poetry with a $500 tuition. So we have the poetry supplies to be $300. The enrollment cost is $20. The fixed cost for the course for the instructor's salary is $3,000, and the rental cost of the classroom is $1,500. So the break-even sales would be the fixed cost divided by the unit's contribution margin. So remember, our fixed cost here is the total of these two numbers, 3,000 and the 1,500. That's the 4,500. And we divide it by the unit contribution margin, which is the 500, which is the tuition price, minus the 320, which is the total of these variable costs, and that would be 180. So we take 4,500 divided by 180, and that would be 25 students. So the course would need to enroll 25 students to break even. Alright, so that concludes Chapter 20. I hope you enjoyed that chapter. I think it's very practical, relates to real life, and it's very useful application for things that we can use in the future. I wish you all the best.